This is part 6 of chapter 5, so welcome. We're going to start here in this segment with gifts and inheritances. Easy concept. Gifts and inheritances are not included in gross income, so they're an exclusion from gross income. Now, in order to be a gift or inheritance, there has to actually be a motivation on the part of the donor to make a gift or to intend to make a gift. We're looking at the donor, not the recipient. And there needs to be some sort of affection, admiration, sympathy, or similar emotion that the donor feels towards the other. Okay, so it's a direction from the donor. We don't care really how the recipient views the transaction. And there's also a $15,000 amount that we mentioned that's annually excluded from gift tax when the donor transfers property to beneficiaries or heirs or loved ones. Okay, and that's $15,000 per individual that the donor wants to transfer, and that's excluded from the gift tax. We also mentioned the estate tax, and that an estate could be $11.18 million before it's subject to tax. Okay, now what about someone who receives a large inheritance from an estate? Any income they earn is subject to tax. Same with a gift. Any income that's earned is subject to tax. Life insurance proceeds are often used for estate planning purposes because they are excluded from someone's gross. When the policy matures, someone dies, the proceeds are excluded from gross income. So you can often use these for estate planning to try to move assets out of someone's taxable estate. Couple of exceptions here you generally would not see, but if someone actually cashes it in before death and receives proceeds that exceed premiums, that's very rare. But if that were the case, that would be taxable. They're getting more than they would put in. We're actually going to then tax them on the income that's been accumulated in the policy. Or if it's used as a substitute for taxable income, in other words, they're exchanging it, and that actually gets also into your transfer. It's an exchange for consideration. Nowadays it's fairly popular to sell life insurance policies. If someone wants to get a different policy, they'll often sell the existing one, which means someone else is going to get proceeds when that unrelated individual dies. So the third-party buyer would have a taxable consequence at that point. A couple other things here. With respect to accelerated benefits, so they're okay if you're chronically or terminally ill, still excluded. And any income that's earned on the proceeds, just like the gifts and inheritance, any income is included in gross income. Long-term care. If someone purchases a long-term care policy and then actually needs to start collecting on it because they need care, they cannot no longer take care of themselves, those benefits are excluded from gross income as long as they don't exceed $360 a day. I'm not aware of any insurance company that would provide a policy greater than that, so this is typically not an issue. The bigger issue is, when is someone considered chronically ill? And you can see they're unable to perform 2 daily activities. So we've got a list of 6 daily activities. They're unable to do 2 of those. They would now be chronically ill, and should they be unable to care for themselves and their policy pays out, they could exclude those benefits. Foreign earned income compensation, we have a maximum amount that can be earned in a foreign country that's not subject to use tax. Remember, the U.S. has a worldwide tax system for individuals. And essentially the idea here is you're working in a foreign jurisdiction. That foreign jurisdiction is going to tax that individual, and the U.S. government is as well. So we have this double tax. We can exclude some of it to try to alleviate that double tax. There's also a credit that works to try to minimize that double tax. You might also see this, not so much with compensation, but the foreign tax credit is often useful if you have high wealth individuals who are investing in foreign securities. So they might have some equity or stock investments of companies in the UK or Germany or things of that nature. They're going to pay tax on dividends to the UK or Germany or whatever country it might be. They're eligible for a foreign tax credit on their individual tax return in the United States. Workers' comp is excluded. Someone has suffered an injury And an injury would be this idea of capital investment, the return of capital doctrine kind of come into play here, that because you're unable to work, you've been injured, we're not going to tax you on that compensation received. Damages. Damages follow that same idea. We're basically not going to tax what's deemed to be a return of capital. And we'll tax anything that's technically really more like income or gain. It gets more difficult though because sometimes it's not clear what is the return of capital. Congress has attempted to clarify that, and it's a rather harsh rule, I think, in some instances, but we can exclude from gross income damages only when they're representing physical injury. So if someone is injured when they're crossing the street and hospitalized and etc., and then they sue and they receive damages from the party that maybe hit them when they were crossing the street, hit them in their car when they were crossing the street, then they would be allowed to exclude those damages. They had a physical injury. Okay, or sickness, you can see that, but more commonly it's physical injury. Now, some types of damages are just punitive. In other words, we want to punish that party that hit us when we were crossing the street, and the court will reward punitive damages over and above the physical injury. That would be taxable. Okay, so punitive, compensatory, reputation, someone slanders you, libel, that sort of thing. Those are all going to be taxable, so they're included in gross income. Okay. Any expenses, litigation, things of that nature can be deducted, but the deductions are somewhat limited, and we don't want to really get into deductions right now. So we have this issue. One, what amounts would be included in gross income in the following? Taxpayers, explain your answer. So Janice sues Tiny Tots for personal injuries. From swallowing a toy, Janice was paid $30,000 medical costs and $250 of punitive. Punitive this is going to be the taxable portion. And of course this we would say is for the physical injury. And so she could exclude $30,000 and include the $250. Carl was injured in a car accident. His insurance paid him $500 to reimburse for his medical expenses and an additional $250 for emotional distress. Now, emotional stress, if it tags on and it's part of a physical injury, is also excludable. So Carl is going to get to exclude the full $500 of medical as well as the $250 for the emotional distress. So the total exclusion then is $750. Okay, here we've got Alex who publishes a story about Pete, and apparently it's untrue because Pete is going to sue for damages. We've got libel here. So Alex loses in court, so he really did say something bad, published something bad about Pete. And Pete is awarded by the court $20,000. Okay, there's no physical injury, there's no sickness here, there's no emotional distress related to a physical injury or sickness. As a result, this $20,000 is going to be included in Pete's gross income. Beavis was laid off from his job last month, and now he's withdrawn $800 in unemployment benefits. Now, unemployment differs from workers' comp. Worker comp has an injury. Unemployment is just in lieu of regular salary or wages. So it's going to be include. Last here we have disability. And disability benefits can be included or excluded, and it's going to depend on the nature of the underlying disability as well as who paid for the coverage. We start off with the assumption that the employer paid for the disability coverage. Generally, if it's a minor injury that this individual has suffered, this employee has suffered, it's going to be includable. It's excludable if there's some permanent loss or use of a function or member of a body, some permanent disfigurement. So we're looking now for something that's permanent. If there's permanent disability that results, then the benefits are excluded. So permanence allows for exclusion, but something that's rather short-term would be included. The benefits would be included in gross income. Now, the taxpayer had the foresight to buy the coverage himself. The benefits are always excluded He didn't get a deduction for them, whereas the employer did. So he didn't get a deduction when he was paying the premiums on the policy, and should he suffer some injury that causes him to collect, then he would be allowed to exclude the benefits. If both of them paid, so it was a joint policy, we then prorate. This concludes Chapter 5, so thanks for viewing.